Three, two, one. Hello, everybody, and welcome to another Deferred Sales Trust Masterclass, where we believe most high net worth individuals and those who help them, they struggle with clarifying their capital gains tax deferral options. Not having a clear plan is the enemy, and using a proven tax deferral strategy such as the Deferred Sales Trust is one of the best ways, if not the best way, to exit highly appreciated cryptocurrency, business, real estate. It could be a primary home. It could save a failed 1031 exchange, all so that you can create and preserve more wealth or help your clients, friends, and family do the same. For those that don't know me, my name is Brett Swarts, and I'm founder of Capital Gains Tax Solutions. And I'm joined by one of my strategic alliance, one of my business partners, financial advisor, CFP. I call him the CPA Whisperer, Jake Miller. Jake, how are we doing today?
Doing wonderful, Brett. It's a great day to be here.
Absolutely, and I'm loving the new what is that new vibe in the background? Some piece of artwork. What is that piece there?
We have Wall Street. We want the rest of America to know that the very best of Wall Street can be had anywhere.
Exactly, even in the Midwest, right?
Right.
Where you're located. And so for today, Jake, can you give our listeners and give everyone who's attending a little bit about the vision? And just so you know, we typically cover the vision while we're here. Then we cover like the deal close story of the week, and then we open it up like a class. It's a master class. It's a mastermind where we're bringing up any and all questions. We're bringing up challenges that people are facing, questions that we're getting every week as we continue to try to make the Deferred Sales Trust simple. So Jake, take it away. What's the vision?
The vision for today is for all of those people who have highly appreciated assets, whether it be real estate, crypto, what have you. There's a way to defer those capital gains without using a 1031 and reinvest in things that are not considered like kind. So something a little bit more flexible, we can move forward with a investment purpose into the future, reinvest in those assets that we might have to sell today without having to pay taxes today.
Fantastic. Exactly right. And we're also joined by the Pierce York, who's taking over the Capital Gains Tax Solutions podcast. He's part of the Capital Gains Tax Solutions team. He's also a luxury expert realtor, Newport Beach, also doing some commercial real estate. Pierce, how are we doing today?
Good. How are you, Brett?
Doing fantastic. You're kind of in the dark. You look like the guy who's like getting interviewed for the FBI, where they don't want to show the guy's face and they distort his. There you go. Get in that Newport Beach light, brother.
Oh, hey.
There he is. And we got the Rubik's Cubes. By the way, I got a new Rubik's Cube. Part of the vision too is making your situation or helping you make your client situation congruent. And what we call that is tax flow, not just cash flow. So Pierce, Give us what that looks like. What does that look like on a day-to-day basis as people are approaching you with the Deferred Sales Trust?
Yeah, so there's a couple different things. The first thing is that it's really helping people, number one, understand that concept. Like there's a gentleman I'm trying to work with right now who's trying to sell two houses in Newport, and he bought them back in the late 90s. They're worth about $10 million collectively. He's trying to get 12, he put about $1 million into them. And so his basis is about 1.2. He's going to have a $3.5 to $4 million capital gains tax if he sells that property for 12 million. And we're trying to show him like, hey, there's a solution out there that can save you. Yeah, you might not get the best price, right? You might get, 10 million as opposed to 11.5, but you're going to save an extra $2 million. If you think about this tax flow concept as opposed to just what can I sell this for the most. So that's just a really quick example, kind of real life on what that kind of looks like.
Yeah, that's really well said, Pierce. And so it's not just cash flow, it's tax flow. It's not just what you sell for, it's what you net. And that's really the key, right? That's really the key. You want to make sure that you're figuring out ways to make not just one side, let's say like the red side is the highest price, right? And then you have like the green side, which is like the best terms. And then you have, let's say the orange side, that's the tax situation. That's why potentially you do like a 1031 exchange, right? Now that might mean the yellow side needs to be a good opportunity, right? And there's a number of factors. The one deal close story that we actually covered last week, but we didn't go into as much detail. By the way, I'm releasing a DST Man on the Street video. It's actually going to be live on YouTube today, so you can see me live in Chula Vista in an area that was a piece of property that was in kind of a lower income area that wasn't being utilized to its full potential. and they bought this property, and then they developed a car wash, and not only did they develop it, but they ran the business, and then they were able to sell it. And it was hilarious because they got a call and they said, we weren't looking to sell, but people were calling us to buy. And we said, well, what do you have to offer? And the guy said, somewhere around 11 or 12 million. And they said they would have took 10. And then, but he didn't tell them that, of course. They said, well, we want more like 14. And they settled on 12.75. But part of their challenge with their Rubik's Cube was their multiple partners, and one of them wanted to get cashed out. One of them wants to continue the development business. One's a little bit older and is kind of ready to retire a little bit more. And so you have this, it's kind of incongruent, right, with it. And so the 1031 exchange typically means that everybody, the whole entity must move. It's got to be equal or greater value, and it doesn't necessarily serve everybody. And you end up with like a disjointed, all the different colors. And so the question is, how do you create something that's separate from each individual and separate the partnership so each can get as much as they possibly can with their time, their energy, their location freedom, and also their entrepreneurial freedom. So Jake, talk about the flexibility of the Deferred Sales Trust and how you can be entrepreneurial with it, but you could also be passive and just retire.
Exactly. So I like to call this one of the most flexible financial tools that people can incorporate. Typically, you have to have some kind of assets, some kind of eligibility requirements to be eligible for it in the beginning. But once you have it, the nice thing is that you can sell off into the sunset and you can use it like a retirement account. However, I would say most of our clients use it for reinvestment purposes other than just marketable securities. And the flexibility there is critical and key to them being able to invest in a syndication, some kind of multifamily or what have you, or for them to then help a friend, or they themselves go start another business, like you mentioned with the car wash, right? And perhaps they want to get in and out of several different properties. Perhaps they're in some single family rentals and they want to be in commercial, and that's okay. They might come in and out of the market based on timing, and they might go in and out of other investments, such as crypto, and that's okay. The point at the end of the day is that if we can pull ourselves back from the typical financial advisor mindset and be unbiased when it comes to asset class and become a little bit more of a fiduciary and do what's in the client's best interest based on their desires, their objectives, then the DST becomes a very, very good tool, very flexible for that type of purpose.
Yep, absolutely. And so that's why we're here, is to explain this, to make it simple. But Jake, it seems like it's too good to be true. Like, why wouldn't, my CPA know about this? Jake, you had a chance to coach and train and work with and dissect and mastermind with, thousands of CPAs over the years on about, 300 to 400 strategies. And this one seemed to come to the top, right? But at the same time, like, why isn't everyone doing this, Jake?
I had a conversation with a gal from Georgia about this just yesterday. And here's the thing. And I was able to speak to the CPA. We had a very open conversation that was critical. But oftentimes, if you go to your CPA and say, I want your recommendation on this, is it good or is it bad? And if they've never seen it before, well, they're not going to tell you that it's good at first glance, right? I mean, they have to get all the information. And one, if you're not going to pay them to get all the information, or two, if they don't have time to get all the information. And if you're just looking for like a quick answer, like, hey, have you seen this before? They're going to say, well, more often than not, they're going to say, no, I haven't seen this. And why is that the case? This is a very protected strategy. It's been around 25 years, thousands of trusts. But when we compare that to some of the other things that are out there, if we talk about thousands versus hundreds of thousands, there's a difference, right? It has been tested by the IRS on a number of different occasions, whether it's a review or an audit, 22 different times. The law firm has defended it before the IRS and has won every single time. So these little things that I'm talking about, as we start explaining it to individuals who are advisors to our clients, they start soaking this up because it's good information. It's information they didn't have before. It also helps them know that maybe it's something they should look into more deeply. Again, at the end of the day, if somebody's not seen this, they can't really opinion on it. And if they're your advisor and they're afraid of maybe having to do it themselves, well, they might shy away from it if it's not something that they've done a dozen or so times.
Yep. So well said. In fact, we also encourage people to bring their CPAs along, because guess what? Jake and I are not CPAs, and neither is Pierce. But the CPA tax attorney who created is, and he's one of our business partners, and he's what we like to call like the Bill Gates of tax. He's brilliant, and he's the one who's been through the fire with the IRS, which is really important, right? You want to make sure that whatever strategy you're going to be employing has actually been through audits, right, and has been reviewed by national law firms, and as well, we have outside groups. We have a former IRS agent that a client of ours, he said, "Hey, look, guys, this sounds amazing, sounds perfect, but I need a third party who's not in with you guys right now, who maybe hasn't seen this yet. I need them to do a deep dive." And Jake and I's client, he's selling about an $8 million business in Southern California. And so he hired this particular person, paid him money. That guy signed an NDA, and he did a 90-day deep dive. Now, in his scenario, it was nice because he wasn't quite selling for another 6 to 12 months. He had lots of time. We're looking like we're going to be closing that deal here by June, which is a great deal and great opportunity for him. He had zero basis. It's literally probably 40% more that he's going to have for his family and his wealth, and being able to give to the causes he believes in, all of the different cool things. But the point of all that is, that gentleman went through the due diligence, did the homework, had the time to do so, and actually did the deal. Now, some people don't have the time. In fact, some people are like closing. And in fact, the one that closed in San Diego, I mean, we had 4 weeks basically to get this thing done. And from the time they had heard about it on the podcast, YouTube channel with myself, and the time we went through and closing, it was about 25 days. And it was intense. And it's kind of like two reels of thought there. Like you could call your CPA, and he says he didn't heard of it, and then you're just going to sell. And remember, those gentlemen were not going to do a 1031 exchange. And remember, most properties and assets do not qualify, or let me say it this way, most assets do not qualify for 1031. The only 1031 qualify for 1031 is an investment property, but cryptocurrency, primary homes, businesses don't. They weren't going to do a 1031, so they were either going to like just lose and pay the tax, so you could just be like, oh yeah, I'm just going to lay down, or they could look at the evidence, the thousands of closes, the billions under management, all of the professionals who have vetted this and are with us and put their name on it, like the David Youngs who ran with the Bill Grosses that are with PIMCO, or and they could go with us, and they did, right? And now they're deferring millions of tax, and here we go, right? So it's really cool that closed, and so that's the point. We want to give you guys confidence. So that's the biggest false belief to overcome: is it legal? Is it too good to be true? We can tell you it's legal, it's worked, it's never failed unless something changes. In California, in the United States, I have one gentleman who I was set to meet with. He was excited, and now he's saying no because he watched some other video about some attorney online saying something about the trustee or something like this, and I'm going, well, are those people even closing those deals? Like, who are having these opinions? So my point of all of this is, take your time with us. This is why we're here. We want to hopefully give you some confidence and some clarity of why this is legal, why it works, and then give you the evidence for all of that. That being said, Jake, we are working on a couple deals right now. And do you want to, there's one in Florida that we're working on, right? There's another one for another business that's being sold in California. Do you want to kind of talk about some of the deal specs on a live deal right now, some of the challenges that some of the clients are facing? In particular, I'm thinking about the estate tax challenge for the kids that are helping the parents sell their California large business and real estate.
Absolutely. So a number of our clients are considering several different options, and oftentimes narrowing things down to the Deferred Sales Trust as perhaps the best option. And let's talk about a few of the things that they look at. This week, I think not just with this group in California with the kids and the parent and the dad, right? But a few other conversations I've been having about people who are considering a CRA or a CRUT, which are two variations, the two most common variations of a charitable remainder trust, which offers numerous amounts of benefits, and I won't discount it at all. But for an individual who wishes to continually reinvest those assets, and at the end of the day, leave more to their legacy rather than to a charity, it's not always the best scenario, other than it might be a really good scenario for saving on taxes today. How the DST might be a little bit better when compared to those products for individuals in this scenario, this family, son and daughter, both very intellectual individuals, working with mom and dad to try and help them with their planning. They have a family business that they're looking to sell, and it's going to sell, and the proceeds to them net might be around $10 million. And that's wonderful. Talking to them a little bit more, there's substantial other assets that will be sold in the future as well. So the estate tax limitation, Brett, as you brought up, is 22 million, whatever, right? It's a threshold by which if you surpass that with items that we are transitioning from our estate on, then we end up paying an estate tax. And that estate tax can be as high as, well, it is 40%. And so if we talk about the income taxes, which in the state of California can be rather high, what is that, 13.3 from the state itself, plus, another 20% federal, plus the Obama 3.8. And then, Brett, if we tack on top, if at some point things literally do transition from one generation to the other because of the estate tax, another 40% on top of that, on some of these same assets. This can be a very difficult situation for a lot of families. So conversation with the Deferred Sales Trust, what we're able to do is technically freeze the assets today so that they stop accumulating within the estate, because we're transitioning them out with the Deferred Sales Trust Plus, right? We're moving them out of the estate and we're able to allow them to then grow inside of the trust rather than inside of the estate. So we're able to kind of freeze things in time within the estate and then continue to grow things through reinvestment strategies and with the Deferred Sales Trust here. And I say here because the estate is here. And if you can see my visual, that makes sense.
Yep, very good. And also we're always welcome, different strategies, the Deferred Sales Trust versus the 1031, and comparing and contrasting the two. And sometimes we tell you to go for the 1031, the Deferred Sales Trust versus a CRUT or a CRAT or a CRT. And we'll give you the pros and the cons of each. What was interesting in that conversation that we had, and we did a deep dive with the DST tax attorney on this, and he broke it down to its essence of, because he closes Deferred Sales Trust, obviously, because he created it, but also Charitable Remainder Trust and CRUTs and CRATs. Like, he's one of the top attorneys at Arthur Anderson prior to him forming his own law firm, all these things. And he's just saying, here are your options, and that's really the key. We want to give you guys clarity, give your clients clarity, help you understand this so you can make a clear decision. And it was funny because I think they were still leaning towards the Deferred Sales Trust in the beginning, but then as he broke it down even more to its essence of the things they thought were benefits, but then they were like, oh, that's actually really not as good as I thought it was. By the end of it, they were like laughing. They're like, oh my gosh, like the Deferred Sales Trust is clearly the winner here. So those are things that we can do. We can break down for you guys and everybody who's curious about those things. But the CRTs are more well known. There's 5,000 attorneys out there, maybe 10,000 are doing them. And so again, there's this belief that, that must be a better way to go. Well, could be, perhaps, depending if you want to give most of it away to charity, and if you want to be maybe a little more restrictive on all of the investments, you don't want to be as entrepreneurial, and those types of things. You don't maybe have kids that you want to pass to. I think you said a good thing, Jake. You said typically for the CRUTs or the CRATs, depending on the CRTs, it's generally people perhaps that are obviously more charitable inclined, but also number two, they typically don't maybe have kids, right? There's maybe not that part of it, but maybe you can explain real quick, why would someone use a CRT or a CRAT, Jake, versus the DST?
Well, and it's not always that they don't have kids. It's just that the benefit they want to provide to their kids is limited in time. So they might want to provide income for themselves, income for a spouse. They might want to provide income for their kids, but for a limited period of time at which there's a stop, and then everything is donated to charity. And
when does it stop? It stops upon their death, correct?
Oftentimes that's the way it's structured. There are some variations of all of these things, but talking about how things are typically structured, you're correct. Mm-hmm. And at the end of the day, if that's not your goal, if that's not your plan, to be super philanthropic and to give away 70% or more of your asset that we're discussing right now, then something more along the lines of a Deferred Sales Trust accomplishes more of those goals. Now, one thing that we did explain, if you are charitably inclined, but you're not sure that of everything you want to be giving the largest piece away, so to speak, it's really hard to undo a CRAT or a CRUT. Once you've done it, it's done. I mean, it's almost impossible to undo. However, if you do a Deferred Sales Trust, and let's use these people as an example, $10 million goes in for the first sell, right? And you decide that, hey, maybe a little bit later you want to use $2 million for a CRUT. That's perfectly fine, Brett. We just do a little K1 distribution. It comes out of the DST. They've got the $2 million. Then they can do which they're would normally be a taxable event, right? Taking the distribution personally, and then they can do their CRUT. We utilize the Deferred Sales Trust as perhaps the most flexible piece or the keystone for a lot of the individuals who qualify for it. And then oftentimes we add to it other strategies to help accomplish their goals, if their goal is philanthropic.
Perfect. Excellent. Now we're going to open it up to everybody to talk about the Deferred Sales Trust, ask questions. If you could also put in the comments like where you're from, your first name and where you're from, that always is kind of cool. And then you can unmute yourself. You can raise your hand. You can type a question. And so we're going to open it up for any and all questions from anyone here today. And so go ahead and unmute and ask away, Jake or me, or even Pierce.
I actually have a question.
Go, Pierce.
Jake, you said that the Deferred Sales Trust has been just tested through the fire and never never been changed or found any changes with the IRS. Has that happened with the 1031? And what ramifications have happened with the 1031 for just comparison's sake?
Yeah, well, and you're asking me to provide a history lesson, and I'm not exactly prepared to throw it all out, right? Because a lot of times with questions like that, I want to go back and make sure that I got all my I's and crossed my T's and provide you dates and times and everything else. To be honest, I'm not sure how the 1031 may have evolved over time. It is something that, as we've noticed, has received a lot of attention in Congress. And if you just watch the legislative tweets, you can see some of their back and forth on the discussions, right? And so more in respect in answering your question to recent conversations, there hasn't been any conversations about from our legislators in changing a DST, whereas there have been not only suggestions and changes of undoing it, disallowing it, or changing it in such a way that it's no longer a tax-free event with the 1031.
Yeah, and they also limited it too, right? So they went from like businesses, and I think you like helicopters or heavy equipment, and they basically have narrowed it down to just investment property. So that's the other thing to keep in mind.
That is a good point.
Yeah.
The like kind rules depends on which administration that you're looking at, but there was a change on the like kind rules that did make them a little bit more broad when it comes to real estate. But as you mentioned, Brett, unable to use equipment and helicopters and things of that nature.
Right, which is also goes into the point of is the deferred sales trust too good to be true? Like, why don't more people know about it? In the past, when people have taken certain tax strategies and stretched the nature and the intent of them to an extent that they become abused, and it becomes so well known that it basically can dissolve the integrity of it. The IRS shuts it down, right? So part of what we have here is so special, and that's part of why it is really exclusive. Now, those who sign NDAs, we work with everybody, but it's also to protect what's here. Because if it gets too well known, or not even so much well known as used by individuals who are not using it properly, then the IRS can just say, you know what, it's got out of hand, we're just going to shut it all down. And that's where we make sure to follow the guidelines strictly. And there's actually a sale, right, to a third-party unrelated trustee. That's our role. And then it's sold to an actual third-party buyer and for fair market value. And there is no constructive receipt because they don't receive any cash. And they're in a deferral state, and they're slowly and they're paying taxes. They receive it, and we're reporting that properly. And so it's the formalities, and it's the business plan and the team to execute this, which typically also helps to explain part of why. People say, "Oh, what are the fees?" And the fees are about 1.5% to 2% recurring per year, and about 1.5% upfront on the gross sales price. And people are like, "Well, how do you what are those about?" They maybe try to make it equivalent to like, setting up a living trust as a one time or an LLC as a one time. Well, those are all commodities, and they're typically one time events, and there's very little formalities after that. But the ongoing part of this, to make sure everything is done properly, to keep the integrity of it, and to keep the track record, so it's protect it, but also to make sure that we're doing things right, is part of where the trustee and the financial advisor and all of us as a team come in. So that all makes sense once you understand that it is a bit complex, but that's why you hire the professionals to help you do all this. So hopefully that adds some value to everyone as well. If you're wondering how to learn more, you can go to capitalgainstaxsolutions.com, capitalgainstaxsolutions.com. Again, I'll open it up again for more questions, comments, thoughts from anybody out there. And I will also invite people too. I'm happy to invite some people. So we got Shane, we got Nicola, we got Rebecca, we've got a couple others as well. Renee, we got Steven, Brian. Anyone have any questions? Or thoughts, comments? We can just keep talking, which is cool too. If you guys want to just keep us here talking about all this stuff. But otherwise, open up for questions. Anybody? Can everybody still hear me? Jake, can you still hear me?
Yes, Brad.
Okay, cool. We'll talk about our book, like we can just pitch the book,
I'll ask another question.
Okay, go, Pope Pierce.
Came up in one of our podcasts, actually. So I was interviewing a guy named Aaron. You guys can go back and look at the podcast, but he's a CPA and whatnot. And he was talking about there's some stuff going on with the Franchise Tax Board of California that they said that they don't like it or they've disallowed it. I know there's some FUD articles that are out there and whatnot, but can you guys speak to that a little bit as to kind of what the actual true situation is on that?
Absolutely. Jake, you want to jump in there and I'll jump in after you?
Why don't you take it first, Brett? I've got 3 messages I'm writing, and then I'll jump right in.
Yeah, absolutely. And let me pull up my notes on this too as well. And so this has been this is one of the things that we get on every single deal basically, because people are learning and they want to make sure that there's nothing that's that it all works. And so the California Franchise Tax Board sent out a notice to qualified intermediaries. This is about 2 years ago, and the notice basically stated that the California Franchise Tax Board doesn't recognize installment sales as a way to save what's called a failed 1031 exchange. Okay, and that's a big statement there. There's a lot of things there, and as a part of that, they're basically putting them on notice to make sure that the withholding that's due to California is paid to them properly, and not paid to them, right? And so, first of all, we always pay the withholding, and if we're working with a qualified intermediary, we're paying that, so that's never been an issue. There were some copycats that we came about, and one of them, in fact, was the monetized installment sale, which has been hurt or blown up or not succeeding in IRS court. You can look at that, and it's now on the IRS watch list, and that was like an installment-like sale. So this actual notice didn't say Deferred Sales Trust. It said installment-like structures, but there was a blogger, a qualified intermediary, who took this and added Deferred Sales Trust and put it on. And so when you search it, it pops up, and it's like, I think something along the lines that California disallows Deferred Sales Trust, and it gets everybody all scared. But here's the reality: like literally, there's never been not one single negative ruling from the state of California or the federal government on the Deferred Sales Trust for 26 years, tens of thousands of tax returns, okay, billions under management. By the way, the tax attorneys provide lifetime audit defense. It's literally perfect. But this blogger who's with a qualified intermediary who has a vested interest, our competition, to not have people do Deferred Sales Trust because they want to keep people in the 1031 exchange, where they get paid, comes out and gives this opinion, right? But he's not the authority on it. So it's almost like this is a smart person. These people are very intelligent, so I don't want to put that. And we're also happy to bring them on and have them share all of their opinions as well if they're hearing this. But here's the reality: like, what's the negative ruling? Right? Like if it's batting 1,000 for 26 years and it's never failed, and it's never failed in California, and the majority of deals are in California, what's the negative ruling? So that's kind of where that's at. Also, to also mention that the IRC 453 is a federal code. It's not a California code. Okay, so it's a federal tax law. It's not California. And then also questioning what is a failing 1031 exchange? Like you got to define that. So yeah, if it indeed does actually fail prior to specific language that we have that's proprietary, that's set up with qualified intermediaries in California that we use on a weekly basis to help people with these things, do these things, then yeah, we would agree if those facts are true. So we well in advance set everything up to do it properly. So if you don't do it properly, then yes, that is true what they're saying. But we do it properly, and that's the key here. And so that's kind of the answer. Hopefully that makes sense, Pierce. Any other thoughts on that, Jake, on that?
Brett, I think you explained it incredibly well. Essentially, it was somebody who was not necessarily an authority on the matter, who was commenting without any documentation or resource information. And again, from a competitive standpoint, not from a let's reveal the truth standpoint.
Yeah, and by the way, here's a little quote here. I'll also read this here too. So this particular qualified intermediary, they make their living doing 1031s. And they know 1031, but they know little else. They don't like any idea that doesn't start with 10 and end with 31. And there's certain sales, by the way, that aren't even 1031s. So like we're working with the seller right now who I think actually read this notice or talked to somebody who sent him the notice. And he's just selling primary homes and investment homes that are, you could just close of escrow. So like if you're even concerned about this, say, well, we don't need to do a 1031. We can just close it at close of escrow. So then that notice doesn't even apply. By the way, for cryptocurrency owners, business owners, that doesn't apply for a 1031. But some people want to. It's almost like the emotions of too good to be true take over the thought of being wrong, and being like, oh, I'm looking for anything that could take a crack on this thing, right? And to give me a reason to just say no, or advisors to say no, but we don't. If you look at the facts and you go, well, I'm not even doing a 1031. Okay, that doesn't even apply. Even if I was doing a 1031, some people even look at it. It's funny. They'll be out of the state of California and they'll look this thing up and they're like, you're not even in the California. Like what? You're in a different state. All that being said, we're still 100% track record. There's literally been not one single negative result. And we keep closing the deals. And then, Ben, back to the logic here. Okay. So if you say, okay, then I believe that's true what they're saying. Okay, then you lose. You pay your tax. Pay your millions of tax and it's over, right? Or B, say, wow, they have a perfect track record. I'm going to go with them and then defer your tax. What would be even the penalty of it, right? Well, you might have some interest if indeed they do come back and audit and say there could be interest that you would have owed. But the odds are that you probably made more interest in that. The interest is actually, I think, like 2 to 3%. It's pretty low on the time that you should have paid the tax, right? So it's not like you're doing something illegal in that sense. It's not like it's tax avoidance because you worked with a legitimate CPA tax attorney to help you structure this. So there's not actually that much downside even if it doesn't work. But if you just lay down and say, oh, my tax person says that's that, millions of dollars, well, okay, well then you can also choose that. So Jake, any thoughts on that, or what am I missing?
I think you laid it all out very well, almost to the extreme of possible circumstances, which hasn't happened, right? So that's a level of comfort that people should be able to have. Again, 25 years, it's been around, thousands of trusts, 22 reviews or audits, 0 findings, 0 changes. Again, this isn't a silver bullet. It solves everything. It should be a strategy that you can use in conjunction with other strategies, depending on how complex your financial world is. But that's why we're here with the trust. Brett Swarts is the trustee, myself as a financial advisor, and other people as well. Sometimes we mix and match so that you have the right fit of advisors around you, making sure that at all times your DST works and functions as it should.
Perfect. Excellent. Well, anyone else have questions, thoughts, concerns? Happy to speak and talk and also hear where you're coming from as well. And again, I will encourage some people here. So you got Steven. We got Front Desk 2. We've got Renee. We got Brian. Brian Newton. Brian, you're on mute. Brian, do you have any thoughts or questions? Brian's muted now, which means no. How about David? David, do we have any thoughts or questions?
Hey guys, I'm actually really new to this concept of the delayed sales trust, so I'm just kind of digesting everything. But I did watch one of your previous videos that I think there's like a 20% withholding that you have within the delayed sales trust, and I was curious if that 20% is also earning interest.
Great question. Pierce, do you want to take that one?
Yeah, I'd love to. So technically, as the trustee, you are now a lender, and so with that, the trust actually owes you back your principal plus the interest set up as the preferred rate of return that we kind of set up with you based on your risk tolerance and everything that we discussed beforehand. And so in order to maintain the integrity of the trust and make sure that, we don't default, we want to make sure that we keep at least 20% in some liquid grade securities so that we can actually, pay and not default on the note. The other 80% can go into hard assets and I mean, whatever investments that you want, but we want to make sure that we keep that little buffer there so that we can continue to pay and there's no defaulting should something go awry.
Great job, Pierce. Any questions on that, Brian? That makes sense. And we can also say that again so you hear it again.
That was great.
David, yeah. So
that was great.
Okay, perfect. Yep. So flexibility there. And then, and some people are like, hey, real estate's really high right now. Let's put it in some conservative blue chip stocks, paying dividends. That's where we work with Jake Miller as the financial advisor. But remember, you have to approve of all the investments, and so does the trustee. And so, yeah, you are the note holder or the lender, right? That's owed back the money plus a rate of return. And then as a trustee, collectively, we're going, hey, Jake, here's what we're trying to get David back. It's $1 million plus 8%. What do you have for us right now? And David's like, yeah, I don't have any real estate right now. Things are just crazy. Like, they're too high. Jake, put me in some really safe stuff that can be hedged and protected and work us through that. And then a year or two from now, David, you might find a deal, or the next day. I mean, you never know when you're going to find a deal. And that's when we're ready to pounce. We can come back into real estate. And that's what we call optimal timing. And that's one of the foundations of capital gains tax solutions, why we created this. And this is what helps you to create a transformational exit plan, is being able to sell high and buy low, not just sell high and overpay for a property in a shotgun 1031 wedding, which is where all of this started in 2008, 9, 10, when I saw clients, friends, and family lose half or everything because of the 1031. It wasn't their friend at that point. It was their enemy. It was tough, right? And this is where the Deferred Sales Trust can be your friend. That being said, Jake, anything to add to that?
Again, this is usually something that we try to put together in a customized way that solves a solution to somebody's capital gains tax event. And it may or may not be the solution depending on what you want to do with the proceeds. Again, if you're going to take the proceeds personally for something that you yourself are going to get some kind of personal benefit from, such as go buying a Ferrari or building your own personal residence, something of that nature, then that would be just a distribution and a taxable event. We wouldn't use the DST for that portion of the money. Should that be all of it or a portion that you would like to use for something personal? The DST we use for reinvestment purposes. It is a business trust. And for that reason, again, we can take distributions over time as we have it reinvested in either marketable securities or some other asset, right? And it can be your retirement vehicle, or under most circumstances, for the bulk majority of our clients, Brett, who are very entrepreneurial, they utilize this tool to continually reinvest and grow their assets through the deferral process of this Deferred Sales Trust.
Yep. It's the idea of tax flow versus cash flow. And we'll talk about it here in a minute. I still want to keep it open for questions for anybody who want to just chime in. We can dive into your question, thoughts, comments. Just go ahead and put it in the chat or just unmute yourself. And then we can talk about how to make the Deferred Sales Trust an investment and not an expense, which is the kind of the number 3 secret to making this thing a home run for you, which is so important because you want to know what kind of return on investment you're going to have. So anybody, we got Renee, we've got Steven, we've got Brian.
I have a question.
Yeah, go ahead, Shane.
Yeah, does this work the same with royalties, or could you sell something like music or a book or something into a deferred sale trust with the royalties coming into that trust adversely affected?
Yeah, so what does the Deferred Sales Trust work for? It works for just about anything that's highly appreciated, at least has $1 million net proceeds, $1 million gain, and that can be captive insurance. It could be carried interest. It could be intellectual property. It could be public or private stock. It could be, of course, investment real estate, cryptocurrency, business sales. So the question I asked you, Shane, is, well, is it subject to capital gains tax? And you say, yeah. Okay. Is it U.S. capital gains tax? You say, yes. Okay. And what is your basis? You say $100,000. And you say, okay, what are you selling for? 1.1 million. Excellent. That sounds like a really good deal on a number of fronts, Shane. And so upon the exit, depending on how it's owned currently, we need to review that with the tax attorneys, the no-cost kind of x-ray of your deal, and then do the proper process of setting up the trust and perhaps assigning those royalties prior to the exit of those royalties to cash. And in exchange, you get a promissory note. So, Jake, anything else to add to that?
No, I think that was great, Brett. At the end of the day, this is just how would you say? There's a lot of initial reviews that we do. So let's say somebody has a deal and they want to know if the DST is right for them. So just processes and procedures. A lot of times they give one of us a phone call, and within typically 10, 20 minutes, we can identify that they're eligible, that it's a good deal, that it's a home run, or that it might be kind of tricky, right? After that, then we do a little bit more of a deep dive. We try to really go into all the details, nuts and bolts, and let them ask all the questions that they want, and bring any other professional to the table that they might need to consult them on this decision. And then from that point, we introduce them to the tax attorney, should they want to move forward with this as an option. Again, they're not paying a retainer, they're not under any obligation, but they can have this put together and ready to go, so that at the 11th hour, as they're signing the contracts to then eventually transfer money, they can utilize the trust, or they can take it personally and pay the taxes.
Perfect. Shane, does that answer the question? Does it bring up more questions, which is great too?
No, that was great. I appreciate it. Thank you.
Yeah. And Shane, where are you calling from, by the way?
I'm calling from Kansas.
Cool. Awesome. Excellent. Thanks, Shane. Thanks for being here. All right. We got Brian, Renee. We got Steven.
Hey, Brett.
Yeah.
So I know longer is better, but what's a realistic kind of fastest time frame you can do, right? So like we've been introduced to people that are going to sell their property and they're like, hey, we're closing in like 2 weeks. Is that like we can pull that off properly? Or is it like, wish we would have known you a week ago, right? Or next one we can go ahead and get this set up for. What's kind of your fastest time frame that you think you could pull off?
Yeah. What's the timing of the deferred sales trust, right? I mean, obviously the sooner the better, right? As you said, because you can properly get to know everybody, the banks, and talk to the client references and bring everybody in. But the reality is sometimes people aren't hearing about us until the last minute. And so the answer is we can close deals in 72 hours, right? As long as the buyer hasn't removed all contingencies. We call that a fire drill, and it's intense, but our teams have done that. A week, 2 weeks, any extra day that we can have is better. But the steps are basically getting the conditional engagement agreement signed, picking a name for the trust, having the call with the DST tax attorney, reviewing the facts, establishing the trust, and then having escrow, having an addendum made or put out before the buyer has removed contingencies, and then closing the deal. Now, there's a lot of, again, this is a Rubik's Cube, and you're throwing us in a Rubik's Cube that's all disjointed and that's out of whack, and it's last second. And so what happens is when there's multiple parties, escrow hadn't heard of it, their brains sometimes can explode. The spouse who hadn't heard of it, that person's head's going to explode. It's all this intensity of emotion, which is part of why we love what we do, right? Because it's like the fourth quarter, there's 10 seconds to go, and we got a chance to hit the game winner and to change literally family legacy, millions of dollars of tax that could be passed and given to charities, that could be just given, provide for your family, and all kinds of cool stuff. Entrepreneurs start new businesses. But we can do it. Yeah. And that's part of why we're setting these. We had Jake and I, we closed a $5 million Bitcoin case, and they basically found us and were like, in a week, that one ended up taking about 60 days, but they found us online and they said they consumed hours and hours and hours and hours of content. And that's part of what helped them to get comfortable with us. And good thing they did, because they sold at 54,000 a coin, although it went to 69,000, but then it dropped down to 35,000. So hopefully that answers the question. Good question. Any other follow-ups on that?
So yeah, the follow-up would be, so we're doing if you're having to do a fire drill, right? Like we're pretty new to this side of the world. What are like the people's roles, right? Like what are we having to do? What are you having to do? What's the attorney having to do? Like how does it all work together? Because ideally there's a team, but obviously we don't know nearly as much as you do or the attorneys. Like what is the different responsibilities there?
Great question. And Brian, just remind me too, give me your background and your focus.
So
let me interrupt you there, Brian. So Brian's a member of an RIA that I just purchased some ownership in, Brett. So I've been training them a little bit on the DSTs, but they're new to this. They're going to be joining our educational webinars from the standpoint of being a financial advisor.
Excellent. Oh, very cool. Excellent. Well, hey, welcome to the community. Welcome to the
dream team, right?
Capital Gains Tax Solutions Nation, right? So, right. So that is a great way. What are the roles, Jake? You want to explain the roles? I've been talking a little bit.
You're doing great. Essentially, Brian, Brennan, Shane, everybody, the roles that each of us play is a little bit different. I want to kind of identify some uniqueness about Brett. This is probably a good moment for me to talk. A lot of times, the trustee is kind of like the doer of like everything. And what do I mean by that? Essentially, so that the IRS, if the IRS ever provides any type of scrutiny or questions, or if they want to do a review on the trust, it's important and imperative that they're looking at the trustee. And so Brett Swarts' name, even though there might be dual signatures here and there or whatever, but his name is like on everything. And he has a company registered out of Nevada that helps operate and provide trustee services for all of these trusts. And Brett, do you mind sharing how many trusts you currently manage and maintain as a trustee?
Yeah, I think we're just over a little over 60 right at this point, and we've done that in about 24 months.
And this might be good just for everybody else to hear if you don't mind sharing. Do you mind sharing the total number of assets, or is that too personal?
I would probably be careful with that, right? So that I don't, my clients who could be listening. Yeah,
that's all right. Let's just say that if it's a big client or a small client, Brett has experience helping people in all ranges, and I think that's probably the important part that people should know, right?
Yeah.
And so a lot of everything that is done in regards to a deferred sales trust should be done by the trustee, coordinating with the financial advisor. Now, if you as the financial advisor are providing a lot of the advice, you need to bring that client to the trustee and then eventually bring them to the attorney. And it's usually we like to do it in this type of a fashion that either Brett talks to a client or I talk to a client, we get this connection and we bring them together, we introduce them to the other, and then eventually to the attorney. And from a order of processes standpoint, it doesn't always matter so much if it's one before the other, as long as both are connecting, and then we bring it to the tax attorney. Does that make sense, Brian?
Yeah, it sounds to me like ideally we're doing introductions and gathering information as needed, but that Brett and the attorney are the experts in actually doing the heavy lifting.
Yeah, Brian, especially in the beginning, right? I don't know if you played any sports growing up, right? Do you play any sports, Brian, growing up?
Yeah, I still try and maintain some. I'm getting worse and worse.
You play basketball at all?
Yeah.
Okay, so I always say like, hey, I played college basketball and it's like my passion, like I love it, right? And sometimes it could be to my detriment because I'm like so competitive about that particular sport. Like you get me on the golf course, man, and I'm like, hey man, I'm out here just to have some fun, hit a couple good shots. Basketball, like it's really intense. Now here's the cool thing, like I'm like, hey, everyone's welcome to play. We do the Saturday morning, Sunday morning runs early, like 6 a.m. and we all run for a couple hours. It's like, hey, everyone's welcome as long as you play your role, know your role, right? And by the way, your role could change over time as you improve in your craft, right? And by the way, my role, and I told Pierce this in the beginning as well, as he started about 6 years with me. Jake is different because Jake is like on another level with his experience already. But my role, especially in the beginning, is like a fly on the wall, right? Like I'm just happy to be here in the meeting, guys. Like that's where I started, and like literally just absorbing, learning my role, and then figuring out ways to add value to make their life easier. Who's they? The DST tax attorney, like the foundation, this entire thing. How do I learn? How do I prep? How do I become like the nurse, the registered nurse, right? That just checks you in for surgery. So in this scenario, yeah, Brian, the biggest thing you could do is just help people to overcome the false belief that it's too good to be true. I wouldn't get into the nuts and bolts of how it all works or all the details of all of that. We can do the heavy lift there, but we do that by telling deal stories, right? And so most people won't be convinced of what you're telling them because they have a story in their mind. And their story trumps your story until you tell them a better story. And so you can tell all the logic and even all the facts of the thousands of closes and billions under management. That's part of the logical brain, but the emotional brain and the other part of the brain is the story. And so we tell stories to help people overcome false beliefs that the deferred sales trust is too good to be true. And one of the most common ones, the guy named David Young, who ran with Bill Gross, and Bill Gross and David Young are part of PIMCO, right? And you may have heard the story already. And they built PIMCO from 80 billion to 1.2 trillion, and they get approached by a lot of people for a lot of things. Well, David and Bill and about 4 other guys were some of the most successful worldwide money managers, okay? And they all retire and they get a big payday. And then David and 4 other guys form a group called Untitled Capital, and they get approached with the Deferred Sales Trust about 4.5 years ago. And like most people, they're very cautious, and maybe this is too good to be true, but they did the due diligence. And they didn't do a 2-day or 2-week or 2-month. They did a 2-year due diligence on this. Their legal team flew back met with the DST tax attorney, talked to the clients, did a very deep dive. Now, these guys are economists and money managers, and they support financial advisors like yourself and Jake, and they can be a part of the dream team should the client elect to bring them on. It does cost a little bit more, right? It's a part of that, but you're getting some world-class money managers to help support the team. The point of all this, though, they did their 2-year due diligence, and after 2 years, they found out 2 things. Number one, that tax attorney, his name's Todd, might be the smartest person they've ever met. And we like to call him the Bill Gates of tax deferral, right? He's brilliant. And number 2, we're all in. Like, we'll put our name on it. We'll become a part of the Deferred Sales Trust Inner Circle. And again, we'll support the financial advisors, support the trustees with the Deferred Sales Trust. And that's powerful, right? So if you tell that story and ask this one question, it helps people to overcome the false belief of it's too good to be true. And this is the question, like, if it's good enough for David Young and his legal team, after a couple years of due diligence, after a deep dive, who's some of the best in the world at what they do worldwide, right? Is it good enough for you, Brian, Jake, and David, everyone on this call, Pierce, and our legal team, right? And hopefully the answer is yes. Yes, it is, now that you put it that way. And oh, by the way, can we get David on the call? Let's get David. David was on just 2 weeks ago on our mastermind telling his story. So does that make sense, Brian, on that?
Yep. Sounds like we'll start by just going through Jake and let Jake facilitate, and we'll kind of follow the lead there.
Yeah, that works. It works too, man.
One of the things that Brett oftentimes tells people that differentiates him from somebody else on occasions is that he's done the 10,000 hour thing, right? So when he talks about being a fly on the wall and being a sponge and just soaking it all up, it is a bit of a learning curve. It doesn't mean that you can't talk to a client about it, but bring others in to the mix so that you can be getting that 10,000 hours until now you become the subject matter expert.
Exactly right.
Still won't have Jake's hair though. That's an acquired skill.
That's God-given, baby. That's just good genes. That's just good genes. Anybody else? Anybody else have questions? Brian may have some more, but we have Renee, we have David, we have Steven. We've got Pierce. Pierce is still learning too, which is great. I love how humble he is and always asking really great questions. This is part of why he is leading the podcast right now, because he's asking really good questions. Anybody? Rebecca. Rebecca, by the way, is our luxury strategic alliance out of Lake Tahoe. Rebecca, we haven't checked in with you in a little bit, and she helps people sell high-end luxury homes on Lake Tahoe and in Truckee. What's going on, Rebecca? How's everything going with you?
Things are going great, Brett. I have a client who's looking at selling a home and then with, $1 million in gains, and then wants to invest in commercial real estate. So, definitely need to take that next step and get you guys connected.
Is it a primary home?
No, it's a second home.
Okay.
So, yeah.
So it may or may not be qualified for an investment or 1031 if it's a second home. They don't rent it out?
Correct.
Okay, cool. So it's Deferred Sales Trust. What are the specs? What do you think it'll sell for?
So it'll sell for probably 1.5, 1.6, depending on how many offers we get. And not listed yet. They have other commercial property in the Sacramento area. And I think they're looking at buying more. And then they bought it for about $515,000. They've paid it all off. They've owned it for about 10 years now. So
okay, so let's just call it about $1 million gain, about 500 and about 1.5 net of closing cost. And it's California, you said?
It is. Yep.
Okay. And you know how long they've owned it for, approximately?
About 10 years.
Okay, so it might even be a little bit lower basis there too, but either way, about $1 million gain.
Well, they've paid off their loan.
Okay, that's good too. So there's no mortgage over basis issue. So we're going to use 20% federal, right? 13.3% state of California, 3.8 Obamacare tax. And then we just roughly throw in an extra bonus 3% for depreciation recapture. So it's probably about 40% of that $1 million gain, which is $400,000, right? And so it's very clear. You draw a line down on the piece of paper, say, hey, would you like to sell and defer about $400,000 of tax? Or would you like to sell and not defer and pay $400,000 of tax? It looks like a home run for me. Any questions on that so far?
No. No. Where'd you get like the depreciation, like the 3% depreciation? Why are you throwing that in?
I asked you how long they've owned it for, and you said about 10 years, right? And so every year, if you take residential, 27 and a half years is multifamily or residential investment property. That's the schedule. If it's other than that, like if it's industrial or retail or office, it's going to be 39 years, right? Maybe 39 and a half. And so you can estimate it's about 10 years, or you could take the price and you could do the whole math on it. You could say, okay, what'd you buy it for plus improvements? And then what you actually have been taking in straight line depreciation. I have found that generally speaking, if you add 2 to 3%, you're going to be pretty much close to where it's going to be at. Okay. So it's kind of just looking at deals for over and over and over again. Now, if you told me they owned it for 27 and a half, 30 years, then I might add, 5 or 8% to that. Right. Because that's how so that makes sense. So for every 10 years, I would say do about 3 to 4%. That's probably a good rule of thumb. So if they own it for 30 years, you could maybe say 9 or 10% is going to be depreciation recapture.
Okay. And since I don't own a second home, and I don't know about the tax implications, but typically a second home that's not rented out, that's just used for personal reasons, is that depreciated from a tax perspective?
That's a great point. Yeah. So if they haven't had a renter and if it hasn't been an investment property, then they probably just haven't depreciated it at all. So the key is what does their tax return say, right? So you go and ask them to check with their CPA, ask them to ask their CPA what is their adjusted basis. Also, this is a great case in point. Don't wait until they're about to sell it 30 days from now. Right now, bring their CPA in, have them sit down with me and Jake, tax attorney, go through it all, right? Have them in the we call it the passenger seat, not in the rear view mirror, right? A lot of people will throw this on their CPA last minute, or again, like Jake said, they're not willing to pay them. They want just a quick answer, and that you can't blame the CPA being like, man, like you're talking about $400,000, you're closing in 30 days or 20 days, and you want this quick answer. Instead, prior to listing, right, prior to getting into the emotion of selling this property they've owned for 10 years for $1.6 million, might be their biggest sale they've ever had, why don't you do all the prep work? And by the way, we don't charge for that. Let's bring the cube in. Let's look at all of the different variations that are all of the different sides. And let's get all the mastermind minds in here with the CPA involved. And let's help us to make this thing congruent so that they can go in with confidence when you list and sell the property, that they don't have to worry about whether the deferred sales trust is legal, legit, it's going to work, what the value proposition is. This is why we're here. Does that make sense, Rebecca?
Yes. Thanks. I appreciate that.
Absolutely. Any other questions on that or comments on that deal?
Nope.
Hey, it's Victoria.
Hey, Victoria. Welcome.
Go ahead. Someone else is going to say something. Go ahead.
I think Rebecca was done.
I'm done.
Yeah. Okay.
Anyway, hey, Brett. Yeah, my name's Victoria Montes. Nice to meet y'all.
Nice to meet you on camera here, Victoria. Yeah, we were talking yesterday.
Yeah, I was able to get off my other call earlier, so I popped in late. So thanks for having me.
Sure. Thanks for being here.
So anyway, Brett and I spoke yesterday. This situation, Rebecca, that you were talking about is similar to a portfolio that I'm looking at, which is actually my own. I'm also a commercial real estate broker and residential. And so my question to you, Brett, is one question. I have a lot of them, but one of them is, what are you finding, you and Jake, in terms of questions and pushback from CPAs? Like when you're saying, oh, let's get on the phone with your CPA. So with these other deals that you've done, these other 60 trusts that you've done, what has been your experience with that? And kind of what have you learned from that?
Yeah, so
Great question. Go ahead,
I'll divide that. I'll explain it a little bit different because we've touched on it a few times during the call. I want to give it a little different light, if that's okay. So I'll say that we sometimes get really good questions or comments or feedbacks, and kind of closed-minded comments and feedbacks. I'll separate the two. And it doesn't necessarily mean if it's closed-minded that it's a bad person, other than it's just their approach to it, right? And so they've never seen it before, they've never heard it before, they don't like it. Those are pretty closed-minded objections and comments, right? Open-minded questions are, well, I've never seen it before, but tell me, has it ever been tested by the IRS, right? So like they're open to asking more and better questions. A better question is, has it been tested by the IRS? Has it been disallowed? Has it worked for other people doing the same thing in the same industry? So if it's a real estate project, has it worked for other people with real estate? Can we talk to a client, right? Somebody else who's done it? Is it so that we know that's just not a salesman's pitch, right? But can we actually talk to somebody like that? Can we talk to the person who's going to write it up? So if it's the attorney or if it's the trustee or who is it, what is their experience? How many years have they done this? How many times have they done it over again? So those are all really good questions that I get. But sometimes it starts out with the other questions, and we have to break the ice, because people who don't know what you're asking them, they sometimes feel defensive, and the barriers come right up, right? And so sometimes we have to approach it in such a way, because it may be them, it might be the client, or it might be the client's advisors. The client might be on board, but now we have to kind of massage the relationship with their advisors, their most trusted advisor, right? And break the ice and get them to help, assist them to go from the closed-minded questions to the open-minded questions, because we can answer all of those open-minded questions.
That makes sense. Any questions of Victoria? And I can also answer it from my perspective too.
I'm sorry, what?
I said I can also answer it from my perspective too. I think Jake did a really good job there. Maybe add a couple things. So
I guess that you're telling me what their questions are. I want to know kind of what your answers are. So when they're saying, and the questions are good, right? So, has it been tested by the IRS, right? What's the experience? How many times have you done this? So those are good questions. I can expect that coming from any CPA.
Yeah. And so the answers are 26 plus years, thousands of closes, billions under management. It's been tested over a dozen times, additional on audits with the IRS. The biggest deal was in San Diego for over $100 million that was tested and no change. Tens of thousands of tax returns over the years, all no issues. So it's literally batting 1,000. It's perfect, right? But even when you tell them that, they're going to be cautious and skeptical, right? And so the other thing we recommend that you bring them along and you invite them into the conversation as you explore it together, right? And so you bring them to the call, and you don't, as the new person, Victoria, learning about this for the first time, right? And I know it because I've been there before. We want to have all the answers, right? And we want to be able to provide it for them. However, we have found that it's not, it's a team approach, right? The more that you can say, hey, it's not just me saying it, it's me and Brett saying it. And it's not just, hey, me and Brett saying it, it's me, Brett, and Jake. And it's not just me, Brett, and Jake, it's me, Brett, and Jake, and the DST tax stream who created it. And the banker, with the big bank, and all of the clients. And it just keeps growing. And so the key is just know that you don't want to go to A to Z all in one conversation. You want to go to A, B, or C, pique their curiosity, and then bring them and let us do the heavy lifting, okay, and help you with that. That's part of why we have a conditional engagement agreement. We do it at no cost, no obligation, right? Most tax attorneys, CPAs, and groups like this who consult will charge $250 to $500 an hour just to have the conversation. We don't do any of that. That's how much we believe in the structure and how much we want to take the pressure off. We will literally get everything set up prior to, ready to go. If the deal doesn't close, you don't owe us anything. And so that's the key I would focus on, Victoria. And then as you have these conversations with us, as you're a fly on the wall absorbing, you're naturally going to pick up on that. But yeah, we can definitely give you the stats. I would just be careful not to bombard them with stats, rather pique their curiosity and then invite them to invite their CPA in, and then let us do the heavy lifting. And then honestly, 9 out of 10 times the CPAs join us, Victoria, and they end up sending us referrals. Okay. Does that make sense? Any questions or thoughts there?
No, I was looking at your fee schedule and I see the 1.5%, right? It's tiered 1.25 to 1.5%. That's correct, right?
Correct.
Okay. So, I mean, I'm just saying for like a typical investment portfolio, it's usually like 1%. So to me, it looks like a little bit of an, aggressive price.
Yeah. Let's cover fees. Jake, you want to cover fees?
Absolutely. So, we do 1.5 of the first million and then 1.25 after, just like you mentioned. But what does that cover? What does that provide? And why is that important? There are people who talk about audit protection. And sometimes all that means is that they're going to go buy a little insurance policy so that maybe if in the future you need it, somebody that you don't even know before will represent you. That's not what these people do. Again, they're batting 1,000. And Todd Campbell himself, it doesn't matter who the attorney was that wrote it up in the group, or who the trustee was, or who the client was, he has represented all 22 times the 10 or so reviews and the 12 or so audits. when the IRS or one of the states has inquired about the trust. And he personally has represented it because he has an incentive to maintain a perfect track record. And so it doesn't matter if he loses money. Yours might have been just a little teeny tiny trust, but he's going to represent you even to the point of losing money on the deal to maintain the integrity of all the other deals, if that makes sense. And it can be a lot of money. We have some people who are doing some rather substantial deals. Brett and I have maybe a little bit later this year, an Ethereum client that might be looking to pull the trigger. That's a $30 million deal. So 1.5 on the first million, 1.25 and all the stuff after that, that's a substantial amount of down payment. But that also is kind of guaranteeing the deferral of a 20% tax deferral on capital gains, as well as the 3.8% Obama tax, as well as any state capital gains or income tax that they might be subject to, depending on their state. And so, in a way, I always tell people this, that you're able to reinvest the sales proceeds of your capital gains asset net of attorney fees rather than net of taxes. That's what they're weighing here back and forth. And it still has to make sense at the end of the day. So it does, typically we try to make sure that the deals are $1 million or more so that the pain of paying the tax is substantial enough that the attorney fees aren't really that big of a deal. And you have to understand that this is a specialist. If I go to a general practitioner, my fee is usually around here when I walk through the door and pay for my checkup. But if I go to a specialist, because there's so few specialists and the education that a specialist has is a lot different than any other attorney that just does any other trust. And so we should expect to pay a little bit more, especially when they don't charge you a retainer up front, but they're going to make their money on the back end should you decide to use them.
And Victoria, by the way, you're in real estate, right?
Yes.
What do you charge for if you were to sell someone's property?
Right. Well, that's 3% or 2%, whatever I negotiate.
Probably higher though, right? If you represent both sides, it's 5 or 6, right?
Yeah, right. Well, I mean, if you're a dual agent, but not typically, right?
Yeah, and so this is actually really interesting, right? So, and to try to make this I want to say this in a way that is very, because I'm a real estate professional, right? And I sell in 5 or 6%, right? But there's literally like millions of us, right? Millions of us that can do that. And we charge 5 or 6% on the sale of a property that millions of other people can do, right? That we could do. And there's literally one law firm that does this, right? And has succeeded for 26 years, thousands of closes, billions under management. And they only charge 1.25 to 1.5, which is, if you think about it, like they're like the Steve Jobs who created the iPhone charging that. And then we're like, we're the real estate professional that's getting paid on a close of a transaction 5 to 6% if we represent both sides, or if you even say one side, right? You can say, oh, well, it's about 3%. Well, that's double what they're even getting, right? So what's more valuable? Somebody who's a commodity, not that you're a commodity. I don't want to say we're commodities, but or somebody who's doing something that's going to help defer 30 to maybe 50% of their gain. So that would be hopefully some encouragement to help sell this, right? Because they are that amazing. And you're getting to know us maybe 24 hours you've talked, right? I think you're going to see that over time where we're at and how we help our clients build more wealth, because it's not just about the exit or the setup or the cost, the one time. It's literally the ongoing team, executive team, if you will, that helps to continue to execute it. Because this is a business trust coupled with an installment sale. It's not like just setting up a living trust where you hire an attorney for $2,500 one time and then you never talk to him again, or maybe every 5 years you do a checkup with him, right? This is ongoing. And so they're going to be talking with your CPA. They're helping you to report it correctly. There's going to be some common questions. And as well, the trustee, 1.5 to 2% with the tax, with financial advisor combined. We are with you this. I mean, sometimes it's weekly, especially in the beginning, and then it's recurring. And then there's strategic, finding deals, doing deals, analyzing what the trust can and can't do. There's so much involved with this, which is why people are like, well, can I just become a trustee? I'm like, well, you can put the 10,000 hours in, right? And go through it. And if they trust you enough, maybe you get their approval to get hired, if you will, right? Or be approved to be a trustee. But that's up to you if you want to put that in. Does that make sense, Victoria? And you're on mute there.
Yeah, right. Yeah, well, you're talking about the sales pitch behind it. So I'm thinking about kind of analytically, right? So from the seller perspective, like say, for example, Rebecca's client. Okay, so they're looking at, they're not going to be paying all that tax in a lump sum, but they are going to be paying it, right? When they get the return, right? The
So
annual-
pause. So when do our clients typically pay that principal balance? Most of them will defer it every 10 years for 10 years and just keep deferring it. And so let me give you the logical part here. So it's the rule of 72. So let's say it's $1 million net proceeds, $1 million gain, and we help them defer $400,000 of tax. Most will not pay that tax, okay? And especially they'll keep it in a deferral state, and they'll live off the interest payments as they come in, okay? And then they can pass it to their kids. And every 10 years, the rule of 72 kicks in that if we could earn 7% net of recurring fees, and imagine they took all 7% and let it compound, Victoria, that amount would double. It'd be $2 million. Now, most will take interest payments, of course, right? But you could say, okay, client, $1 million or 600,000, but the $1 million is paying you about 80,000 a year, net of the fees, okay? And at the end of 10 years, we still have that same $1 million. It's been paying you $80,000 a year. That's what 99% of the clients are doing, Victoria. They're just living off the interest payments, and they're just paying ordinary income tax on that. Now, some will dip into principal, and as they do, they'll pay some capital gains tax. But watch this, Victoria. What if you had a loss of $200,000 3 years from now? A capital loss. Would you might call that capital loss in that same year and pull out 200,000 of the trust? Now you're at 800 and just wipe that away, right? That's one way. Number two, what if you're in a very high income tax state? This is how to make the deferred sales trust an investment and not an expense. Okay. What if you're in a very high income state like California or New York, and you can delay the payments for a couple of years, and you're a very high income earner? In fact, I had a client that did just that. They delayed the payment as they moved out of Palo Alto when we sold their $8.3 million home. And they established a residency in Nevada. And then they started taking payments. Well, guess what? The trust, as it makes ordinary income tax payments on the interest payments, is in the state in which you're in, is the state in which you're going to pay that tax. Well, that's pretty cool because I left California, 8 to 13% savings as I get to Nevada. Wow, pretty awesome, right? So I just took something that would have taken all in California, defer all the tax, establish residency in Nevada. Now people will ask, well, then can I just exit all of it and not pay the tax? No. The California tax is always going to be due to them when you receive it. But until you receive it, it's not triggered, okay? So those are a couple ways to make it an investment, not an expense. Is that making sense, Victoria?
Yeah, I mean, not 100%, but I get the idea. So what is the timeline on this? Like, you can, are there milestones involved in this? Like when you sell the property, and so help me understand. I don't know if you talked about this already, but timelines, any kind of, we're talking about deferring indefinitely, or and what are the timelines of the transaction has this type of transaction, the establishment of the trust and the installment sale, when that like the first series of installments.
In an ideal world, we're 60, 90 days out prior to even listing or getting the property under contract, right? The reality, most of our deals are under contract and are closing within 30 days. And so we can work within about a week to get everything set up. We've done deals quicker than that. The challenge is when you bring in all these different parties, different escrow companies, different brokers, different CPAs, and everyone has their way to solve the Rubik's Cube, and you're pressuring it under this 30-day time frame, and it can become intense. Now, this is what we thrive on, and we do all the time. We just closed a deal in San Diego that exactly what happened, $12.75 million deal. Literally, like, they found us within 28 days, we closed it all, deferred millions of tax. They had went from start to never hearing about it to closing within 28 days. And so the answer is we can do it. The key is we got to make sure that the buyer hasn't removed all contingencies. Okay, that's number one. Or two, it's at a qualified intermediary. The funds are there, and we can save a failing 1031 exchange. We can set up language if you're working with exchange accommodators that will accommodate. Which is, by the way, make sure you get with us so you have those accommodations. So you're not working with someone who won't accommodate or don't know what they're doing or won't cooperate. So, but of course, if it's crypto or business or anything else that doesn't qualify for 1031, we need to do it prior to public or private stock, prior to anything being sold. So those are the general timeframes, Victoria.
Wow, that's a lot. So basically, so you have to have, what triggers it is you have to have a failing 1031.
So that's one option, or you set it up prior to close of escrow, right? And we can exit at close of escrow. Those are two for investment property. But remember, 1031 only works for investment property. It doesn't work for primary homes, businesses, crypto, right? It doesn't work for any captive insurance, carried interest, doesn't work for any of those things, right? So we need to, although it might work for carried interest because it could be in a property that you're moving, right? So yeah, so these are some of the things, but we are running out of time, and these are great questions, Victoria, and I appreciate it. If you come back next week, we're happy to answer these for you and others as well. But that being said, Pierce, if people want to connect with you and they want to get into Newport Beach, commercial real estate, luxury real estate, where can they find you?
Yeah, you guys can find me at kingdomluxuryrealty.com. That's kingdomluxuryrealty.com.
Awesome. Thanks, Pierce. And Pierce, we got some big people coming up on the podcast next week. So look for Pierce talking on the podcast. Rebecca, if people want to connect with you, if you're still there, where can they find you?
They can find me at RebeccaMunson.com, or that's the best way.
Awesome. That's for anything luxury real estate up in Lake Tahoe area and the Truckee area. You want to defer millions of tax. You want a rock star local real estate professional. Rebecca is your gal. That being said, Jake Miller, I think he had to jump off. If people want to connect with Jake, you can go to strategictaxsolutions.com, the strategictaxsolutions.com. And I want to thank everybody for attending another episode or another week of the DST Masterclass, DST Mastermind, where we believe most high net worth individuals and those who help them, they struggle with clarifying their capital gains tax deferral options, and not having a clear plan is the enemy, and using a proven tax deferral strategy such as the Deferred Sales Trust is the best way for you to exit highly appreciated cryptocurrency, business, real estate. If you want to unlock the power of the Deferred Sales Trust to exit like millionaires, you can go to capitalgainstaxsolutions.com, capitalgainstaxsolutions.com. Look for the new book that's coming out, by the way, with Jake Miller in it, as well as myself and a guy named Kevin Harrington from Shark Tank and some other really smart people talking about the Deferred Sales Trust. It's called Building a Tax Deferred Exit Strategy. And so invite someone next week, invite that skeptical CPA, invite that broker, invite your friend or family member who's selling something that's highly appreciated. Who do you know that you could help and this information could help with? Please, we're on a mission to help everybody. We believe everyone deserves a good exit plan when exiting their highly appreciated assets. We appreciate everyone out there. Thank you so much. And we will talk to everyone real soon. Bye now.